Gold scarcity is not a distant threat, it's unfolding quietly but powerfully beneath the surface of the global economy. The idea that we can endlessly extract more gold to satisfy rising demand is a comforting illusion, one that's beginning to collapse. Gold, unlike fiat currency or digital assets, cannot be printed, mined infinitely, or replicated. It is a finite resource, and the deeper we dig, the harder and costlier it becomes to find. The truth is, the world has already mined most of the easily accessible gold. What remains lies deeper underground, often in regions where extraction is more complex, energy intensive, and expensive. As a result, production growth is stagnating even as global demand surges. Mining companies around the world are facing declining ore grades, higher operational costs, and increasingly strict environmental regulations that slow exploration and production. Reports from major industry analysts in mid-2025 show that the global gold supply is expected to grow by just about 1% this year, a number that sounds reasonable on paper but is neglected against the accelerating demand central ban from central banks, institutional investors, and individual savers. This imbalance between supply and demand is at the heart of gold's scarcity story. We're not merely facing a short-term production dip, we're entering an era where consistent, reliable gold output will be structurally limited. The economics are simple: as the cost of extraction rises, miners need higher prices to justify new projects, but if prices remain stagnant or volatile, fewer new mines are developed. That lag between discovery, development, and production can stretch across a decade. So, even if gold prices rise sharply today, the physical supply cannot immediately respond. Another often overlooked factor is geopolitical and environmental tensions surrounding gold mining. Many high potential deposits exist in politically unstable regions where security, infrastructure, and governance challenges make mining extremely difficult. Moreover, global shifts toward environmental sustainability have made large-scale mining less socially acceptable. Stricter ESG standards and carbon reduction mandates are making operations more expensive and complex. As investors increasingly demand responsibly sourced gold, producers must balance profitability with compliance, which further slows the flow of new supply into the market. All of this is happening while gold continues to occupy a unique role in global finance as a store of value and a hedge against uncertainty. Central banks across Asia, the Middle East, and even parts of Europe have been quietly increasing their gold reserves, signaling a growing lack of faith in paper assets and dollar stability. Every ounce purchased by these institutions tightens the available global float, leaving less gold accessible for retail and private investors. With the physical market tightening, premiums are starting to appear more frequently. The message is clear: the world is moving into a scarcity regime where the marginal ounce of gold becomes increasingly valuable. This structural imbalance between finite supply and surging demand is reshaping the dynamics of gold ownership. Those waiting for cheaper prices might be waiting for something that won't come. As mining costs rise, extraction slows, and discoveries dwindle, scarcity will not be a temporary phase, it will be the new normal. And in that environment, every day of delay could mean paying more for less real value. The coming shift in gold's value isn't just about price, it's about perceptions. For gold has been viewed as a defensive asset, something investors turn to when markets crash or currencies weaken. But what's unfolding now is far deeper. Gold is transforming from a cyclical hedge into a core pillar of global wealth preservation. In 2025, we're witnessing a gradual but powerful revaluation of what gold truly represents in an era of rising debt, geopolitical fragmentation, and monetary experimentation. This is not a speculative rally, it's a structural realignment driven by fundamental changes in how nations and investors define safe value. Global debt has reached record highs, surpassing $315 trillion, and major economies are struggling to contain inflation without triggering recessions. When governments respond to debt with money creation, it erodes trust in fiat currencies. People intuitively seek assets that exist outside the reach of central banks and political manipulation, and gold remains the purest form of that independence. Historically, moments of excessive leverage and monetary distortion have always ended in asset repricing. Today, that repricing is starting with gold as more investors begin to recognize that what's scarce and real will outperform what's abundant and synthetic. We're also seeing an evolution in how institutional money approaches gold. Large funds and pension systems that previously dismissed gold as non-productive are now allocating small but meaningful portions of their portfolios to it. This isn't because gold suddenly generates yield. It's because traditional assets like bonds no longer offer real protection. Negative real yields, currency debasement, and rising geopolitical uncertainty have forced even the most conservative investors to reconsider gold's strategic importance. The perception shift is also technological, with digital gold platforms, tokenized ownership, and easier accessibility through ETFs. Gold is no longer an old world asset. It's being integrated into modern finance as a hybrid of security and liquidity. Meanwhile, emerging markets are driving a quiet revolution in gold demand. Countries like China, India, and Turkey are not just buying jewelry. They are absorbing physical gold as a safeguard against currency depreciation and financial instability. The behavior of these nations and their citizens is telling. They're not speculating on gold's price. They're preserving purchasing power. This collective global behavior is pushing gold into a new paradigm where its function is less about trading and more about anchoring wealth. Another key transformation lies in the psychological aspect of ownership. For much of the last 2 decades, investors treated gold as a temporary insurance policy. But as trust erodes in fiat systems and digital volatility intensifies, that insurance is evolving into a permanent position. Gold is regaining its historical role as a foundation of long-term wealth. Not because it's fashionable, but because it's rational. The forces driving this shift are structural, not emotional. When trust in currencies, governments, and markets begins to fracture, people revert to assets that don't depend on anyone's promise. Gold, in that sense, is not rising. Everything else is falling relative to it. This change in perception is the real story behind gold's growing strength. The more investors realize that value is about stability, not speculation, the more they will see gold not as a trade but as a cornerstone. And that shift, once complete, will redefine what financial security means for the next generation. The scarcity of gold is not simply about how much of it exists on Earth. It's about how little of it remains available for purchase and delivery in a world of growing demand. Over the past few years, central banks have been accumulating gold at the fastest pace since the 1960s. This isn't a coincidence, it's a deliberate response to weakening confidence in the US dollar and the global financial system. When nations begin trading energy and commodities outside of dollar terms, gold becomes the neutral settlement tool, a timeless store of value that isn't subject to sanctions, inflation, or political control. As this shift continues, the available float of gold in global markets shrinks, tightening supply for everyone else, from institutional investors to individuals trying to hedge their savings. The mining sector adds another layer to this scarcity problem. Despite rising prices, global gold production has stagnated for nearly half a decade. The easy deposits have already been mined, and new discoveries are both smaller and more expensive to extract. Environmental regulations, geopolitical risks, and declining ore grades are all constraining supply. Even large mining companies admit that we may have reached peak gold, the point where production can no longer keep up with demand. What that means is simple: every ounce above ground becomes more valuable, not because it's shiny, but because it's increasingly irreplaceable. The dynamics of supply and demand are further intensified by the rise in long-term accumulation rather than short-term trading. Unlike in previous cycles, gold is being hoarded, not flipped. Central banks aren't selling. Institutional ETFs are reducing redemptions. Individuals in developing economies are holding on to their gold, viewing it as a form of generational security rather than an investment. This behavioral shift means that less gold returns to the market, creating what's essentially a quiet liquidity trap. The metal's circulation slows even as interest in owning it grows. Meanwhile, the macro environment amplifies this scarcity effect. Persistent inflation, mounting debt burdens, and currency instability push investors to seek safety. Yet, as demand surges, the available supply fails to respond. It's the kind of imbalance that creates explosive moves in price, not necessarily because of speculation, but because fundamentals have been ignored for too long. History shows that when a scarce asset becomes systemically relevant again, the repricing tends to be sudden and dramatic. We saw this in the 1970s when inflation and currency crisis fold from 35 to over $100 an ounce. The pattern may differ today, but the psychology is identical. Scarcity plus fear equals revaluation. What's particularly dangerous for latecomers is that gold scarcity operates quietly. It doesn't make headlines until it's too late. By the time price momentum begins and supply bottlenecks become visible, the majority of investors will be reacting rather than preparing. The wise recognize that scarcity is the foundation of future value. And in this case, scarcity is not a narrative. It's a measurable, structural reality. When an asset as finite and essential as gold faces accelerating demand and constrained production, the question is no longer if it will reprice, but when. Those who wait for confirmation will discover that the shift already happened while they were watching. The fourth key insight lies in understanding that wealth in its truest form is not static, it flows. And when major shifts occur in the global economy, that flow accelerates, moving from weak hands to strong ones, from those who cling to outdated financial habits to those who anticipate the changing tides. The coming shift in wealth and value is being shaped by the silent forces underneath the surface: inflation that erodes paper money, rising debt burdens that weaken trust in government currencies, and an emerging geopolitical realignment that challenges the very foundation of the dollar-based system. Gold stands at the center of this transformation, not merely as an asset, but as a mirror reflecting the loss of faith in fiat systems and the revaluation of what real wealth means. For years, investors have been conditioned to think of wealth in terms of digital numbers on a screen, stocks, bonds, or fiat balances that fluctuate with central bank policies. But true wealth is not just about nominal gains, it's about purchasing power. And purchasing power is quietly slipping away from those who keep their wealth in depreciating currencies. Central banks continue to expand balance sheets, governments spend beyond their means, and the illusion of stability is maintained only through confidence, a confidence that history tells us can vanish quickly. When that happens, the wealth stored in paper assets gets repriced in terms of tangible assets like gold and silver, and the shift begins. We are entering a period where that shift is no longer theoretical. Central banks have already begun the transition, diversifying out of dollars and into hard assets. Institutional investors are slowly following, but the general public remains largely unaware. The wealth transfer that follows such moments is not driven by greed, but by necessity. Those who understand the underlying structural weaknesses in the system, rising debt to GDP ratios, shrinking real yields, and political uncertainty, are positioning early. They are not chasing price, they are seeking protection. And when the crowd eventually recognizes what's happening, it's always too late to buy at a fair value. The redefinition of wealth also carries a psychological component. Most people believe they are safe because the system has always worked for them. Their savings, pensions, and investments have provided growth in the past. But systems evolve. Monetary policies that once stimulated economies are now distorting them. The printing of money may have seemed harmless during low inflation years, but it's now the very reason inflation persists. When the cost of living rises faster than income, wealth effectively transfers from the saver to the debtor, from the cautious to the leveraged, from the middle class to the financial elite who understand asset-based protection. This quiet reallocation is already happening, and gold is one of the few tools to stand on the right side of it. As gold scarcity increases and its role as a monetary anchor reawakens, its price won't just reflect demand, it will reflect a revaluation of everything else. The paper wealth that once seemed dominant will be measured against something real again. Those who understand this shift don't view gold as a speculation, they see it as a recalibration. And when that recalibration accelerates, it will redefine what wealth means in the next decade. In the coming years, the winners won't be those who tried to outsmart the market, but those who prepared before everyone else realized the rules had changed. The final insight ties everything together. The realization that timing is not just about when to act, but about understanding when the world around you is changing faster than your perception of it. Most investors make the mistake of reacting rather than anticipating. They wait for confirmation from the market, from the media, or from other investors before taking action. But by the time confirmation arrives, the opportunity is already gone. The coming phase for gold and silver is not just about rising prices, it's about the reawakening of awareness. That moment when investors realize what they've ignored for too long. Gold scarcity isn't just a supply story, it's a signal that we're approaching a deeper shift in the financial architecture that has defined global wealth for decades. Across the world, mining output is slowing while demand from central banks continues to accelerate. The largest accumulators of gold are no longer Western nations but emerging powers, China, India, and Russia, who see it as a hedge against dollar dominance and potential sanctions. These governments understand something most retail investors overlook: control over money creation is power, and power is shifting. The West built its financial strength on fiat systems and leverage. The East is quietly rebuilding its foundation on tangible assets. The imbalance that's forming will have profound consequences. When confidence in paper wealth falters, even slightly, it sets off a chain reaction. Investors scramble to move into real assets, but supply is limited. That scarcity doesn't just push prices up, it exposes how few truly own what they believe they do. In this environment, waiting becomes the most expensive decision. History has shown that wealth doesn't transfer during calm times, it transfers during periods of transition. The early adopters, those who see the cracks forming before the crowd, capture the upside. The rest rationalize their hesitation until they're forced to act out of fear rather than insight. The upcoming months, especially leading into 2025, represent a pivotal time. Monetary tightening cycles are ending, debt levels are unsustainable, and the illusion of controlled inflation is unraveling. Gold and silver aren't simply alternative investments anymore. They're becoming instruments of preservation in a system strained by its own excess. The deeper truth is that every wealth cycle in history has followed this rhythm. Paper assets rise, optimism grows, leverage expands, and then reality corrects it all. The correction phase doesn't just erase inflated valuations, it redefines ownership. Those who hold real value survive, those who hold promises of value struggle to adapt. And gold, once dismissed as a relic, suddenly becomes the standard again, not because of nostalgia, but because it's the one form of wealth that doesn't rely on someone else's liability. It doesn't default, it doesn't dilute, and it doesn't vanish when markets panic. So the question investors must ask themselves isn't whether gold and silver will rise. That's almost inevitable in the current trajectory. The real question is whether they'll act before the system resets or after. The window between awareness and action is narrowing. The scarcity of precious metals is not just a physical phenomenon, it's an opportunity gap, one that rewards foresight and punishes delay. Those who understand that waiting has a cost will not just protect their wealth in this transition, they'll be among the few who redefine it for the new era that's coming.